This is the Trading Psychology Podcast. This is VP, creator of No Nonsense Forex and author of the book No Nonsense Forex Trading Psychology. And with me, as he is every episode, he doesn't take losses. It's Rob Reinhold.
Hey Patrick, how's it going everybody? I definitely take losses, but I don't take net losses. And that's what we really want to talk about in trading, is that it is a collection of 100 trades, a collection of 25 trades, whatever it is. Yeah, you're just trying to make a profit on those group, not on any individual trade.
Yeah, and you guys know how this works by now. As we get deeper into this podcast series, we start talking about things we've talked about in the past, but expanding on them. And we're going to talk about taking losses again this episode, which we have done before, but understand that taking losses is a really broad topic. It's not just one thing. And so not only do we need to explore all the different avenues here, we need to go really deep into it. And maybe even explore what's going on in your brain, because that does help a lot of people. So that is what we are doing this week. And when we go deep into all the brain chemistry, nerdy stuff, you know this is a Rob episode. So Rob, this is going to be mostly you. And just let me know when you want me to jump in, and I will do so.
All right, thanks Patrick. So everyone, lay down, put your feet up, and let's get inside of those brains. A lot of our episodes have to do with kind of like what's happening out on the market and, of course, what's happening with you inside. But I want to go back to the very start of this podcast. We had 3 episodes right at first. And basically, the first 3 were all about the concept that as a human being, you are flawed genetically as a trader. And how until you recognize that you have things. And it's not about choice. It's not about discipline, as we talked about. It's inherently, I don't want to use the word broken, but let's use the word broken. Inherently disadvantaged to when you as a human being go in and take risk in financial markets. There are things that happen because you are a human being. They don't happen because you weren't disciplined enough. They don't happen because you weren't smart enough. They happen because all human beings have some of these flaws and biases. And we've done a lot of episodes on bias, like familiarity bias and recency bias. This is another one that is innately human. And if you say to yourself, oh, I don't have this one, you're probably lying to yourself. You may not have it as strongly as others, but all of these biases that we talk about, they've been well studied. And it happens simply because you're human. Not because you're dumb, not because you're undisciplined. Happens because you're human.
Yeah, I'll agree to that. Every single person out there, no matter even if you just come from money and you get a trust fund and you're just getting money you don't even care about, it still hurts to lose. You know, back in the Texas Hold'em days when I would play a lot, you could tell there were a lot of drug dealers there, like people who just they cared about money a lot less because they knew if they lost $500, they were getting another $500 the very next day. It meant a lot less to them than it did, a poor waiter like me. So they played a lot differently. They were a lot more fast and loose with the way they played. But let me tell you, they still hated to lose. It's not like losses just didn't affect them. Losses affect you in many different ways, not just monetarily. That's why I said at the top of the show, this is a much more broad topic than a lot of people let on. So yes, I will certainly co-sign on that, Rob. And I am normally this is not my avenue, but I'm really interested to see what's going on inside of us that's creating this aversion to losses, because it's never going to go away. But if we can actually grab a hold of it and be able to control it a little more, I think it can really go a long way.
It absolutely will. And if we really narrow this down into like a definition, I pulled this off of a study from Daniel Kahneman, who is one of the great behavioral psychologists. It is loss aversion is the observation that human beings experience losses asymmetrically, more severely than equivalent gains. Let me boil that down into just like a little story. If you lost $100 or if you found $100, they have measured that it affects you emotionally 2 times greater to lose $100 than to find $100. Now you think, wait, shouldn't that just be the same? It's the same thing. You found $100, you lost $100. Why wouldn't we feel the same as humans? And that's exactly what people have been studying for decades. They've been studying this phenomenon. And again, we're going to call it loss aversion, but if you go out and study this more, it is also known as status quo bias, and it's also known as the endowment effect. So you're going to hear these other two terms. They've all basically studied the same thing, is that when we go out and we experience a loss versus when we experience an equivalent gain, the loss affects us twice as great as any gain will. Now, think about that in your psychology. And we've talked about psychology in this whole podcast. When you go into the next trade, you're going to try to not have any baggage from previous trades. But understand, those losses that you take are going to have twice as much baggage as any wins that come into it. So this is just such a big thing in trading, and I just don't think how much people understand this, that this reality that we experience twice as great of trauma on losses is going to affect the next decisions that we make.
And that part you said about finding money as opposed to losing money makes a lot of sense too. Because just for the simple fact that if I lose $100, that's $100 that I worked for. To where if I find $100 on the street, the only work I did was bending it over and picking it up. So I think that really takes effect too, because I can remember, for example, having an account. Let's say it was $2,000, and I would trade it up to 28, and then it would come back down to 2,000 over time. And it wasn't even the money that bothered me. It was the work I put in and the good work I have done trading so well to get up to 28 that I felt just got completely erased. It wasn't about the money, really. At the end of the day, it was about the work I put in.
And it was not just about the work you put in, but you had built it up to a certain point. And when you experience that drawdown, this is human nature. Whatever you experienced on the way up was twice as great on the way down. And that's when you start to get really into the psychological problems, when you let those things affect you and your psyche so much. It is devastating. And so we've gone through like some of the examples, and they've done tons and tons of studies, and I have so many studies to share with you, but probably not enough time to share them with you. But we've talked about losing $100 versus finding it. Here's one study that I absolutely love. So they set up a simple betting game where people would go and they would bet on, like, let's just say heads or tails. Now, as they stepped up to the line, the first time they did it, they said, you're going to bet $10 of my money. So let's say that I was running this and you walked up to the front of the line and I said, okay, you're going to bet $10 of my money. If you win, you get $10 and I'll get my $10 back. If you lose, I lose my $10. Okay, so they set that up and they ran to see what people did. After that, people stepped up to the line and they gave them $10 and said, this is your $10. They bet completely differently. Now just think about this. In the first study, they stepped up with zero on the line, and they either could have walked away with $10 or walked away with nothing. Now they were given $10, and if they lose, they walk away with nothing, and if they win, they win $10. Do you see that it's basically the same concept? Why did they bet differently?
Well, that's a big question I have. How did they bet differently?
They were more reckless. They were more reckless when it was someone else's money. When they never had that money to begin with, they were more reckless in the way that they were betting. They were much less risk averse. But once you gave them the money, all of a sudden it became their money. And now this thought of losing their money, because they didn't care about losing your money, they cared about losing their money because it's now theirs. It caused them to become much more risk adverse than they usually would have done it. But again, they had to bet or else they didn't get to keep the money. So they tried to make it to where it was similar as possible. But when they felt they owned it, all of a sudden they became more risk averse.
And God, this is reason number 215 why I'm so glad I spent as much time in Las Vegas as I did. You learn so much that a school just could never teach you. This is again speaks to the brilliance of casinos, because they will give people credits, just like you talked about, to where they are giving you free money to go gamble with. And now that you say that, it makes so much more sense, because they're almost always not only going to get that money right back, but they're going to get that momentum going for these gamblers to get excited. And now, you gave me $300 credit. I blew through it. Okay, who cares? Wasn't my money anyway. But now I'm playing. Now I'm sitting down in front of a machine. I'm not going to stop. I'm not just going to walk away. That's not what a gambler does. That's what I would do. But that's not what a real gambler does. So, yeah, this is really, really starting to make a lot of sense now.
And it's not just credits. It's also, why do you think they give you chips? Again, they are so intelligent. They've run all the studies. They've seen what it's like when you are at a craps table or a blackjack table and people are having to bet cash. They become less risky if they have to bet their own cash. But if you give them these plastic chips that don't have all the connotation of hard-earned money, to where in your brain you can be like, well, it's different than money. People are more willing to take risk when you give them $100 in chips versus $100. It is genius. It's also diabolical. But again, they understand the human psyche. They understand that this is how everybody works. By getting people to feel like it's not real money, they become more willing to take risk. When people feel like they have something to lose, they become much more risk averse. There's so many studies, and I would love to share all of these studies with you. Go online, pull up studies on loss aversion, studies on the status quo bias, all this stuff. You will see this has been studied extensively. I'm going to let the internet take everything after that you want to learn about this, because we want to talk about how this affects you in trading. I'm going to start off with a study done by Daniel Putlers on eggs and eggs prices. And I'm going to use this to show you what happens to people in the markets. Back in I think it was the late 80s, there was a big increase in the price of eggs. And so Daniel Putler, he followed this, and he noted that when the price of eggs increased 10%, demand dropped by about 8%. Okay, so it makes sense. Eggs get more expensive, less people buy eggs. Okay, nothing special there. Okay, then pretty soon after, about a year after, prices of eggs went down 10% back to where they originally were. Patrick, do you think demand went back to where it was?
I doubt it, because people still have a little bit of PTSD over what happened before. And they're probably going to carry that over into their decision making now, I would imagine.
You nailed it. That's exactly what happened. Demand rose about 3%. So eggs are eggs, and the prices fluctuate. But human behavior was affected because of a change in prices. Remember, we are all human. We all do this. This affects all of us. So when you go into the markets, the first price you see on any asset class, and you talk to the old guys, I love talking to old guys, I remember when, a candy bar was a nickel, and now it cost $1.50. That's insane. Now look, we all understand that $1.50 for a candy bar that's the price. That's just the price it is. And to my kids, $1.50 is just what a candy bar costs. But to an old timer who bought it for a nickel, they think this is absolutely asinine, and they are much less likely to buy a candy bar, because in their mind, that's a nickel. That's only worth a nickel, and now it's all this money. We do this all the time with gasoline. We always romanticize gasoline. Like, I remember, back in 2008, I remember when gasoline went under $1, because I remember that. That actually happened after 2008 when the economy collapsed. Gas dropped under $1, and I remember thinking, this is crazy. And then all of a sudden it went back up to like $1.70. I'm like, I'm getting ripped off. We all do this. Patrick, you have a time in your life where you've done this as well?
Well, I can speak to gasoline too. Like, I'm younger than you, but I remember in college, if you go to the outskirts of town, they had a gas station there. I don't know what kind of gas they were offering, but it was 69 cents a gallon, and that was way cheaper than anything else. Like, going rate was probably about 80. And so we would make pilgrimages out there to this place to fill up our cars. So this was in the late 90s. And then you had 9/11 happen in 2001, and price overnight shot up to $1.70. There was lines to get gas because people were panicking. I mean, yeah, it's absolutely different. I think gas is this is a little bit off topic, but I just want everybody to know while we're here, and a lot of you already do know this, but gas is the perfect kind of blank slate I want to use, because you have all these people who remember when gas was so cheap. It's still supposed to be cheap. It actually got easier to produce, easier to refine, cheaper to refine, yet the price has gone up so much. It's not because gas actually got more expensive. Gas got cheaper. Your currency got worse. So if you ever want to really blow an old man's mind, let him know that, because I bet you he's never heard it put that way before. But people nowadays, especially since Bitcoin came around, we are constantly reminded of this phenomenon. But to bring it back to your point, Rob, yes, absolutely. All the regret over something you absolutely can't control. Things just are what they are, but you still remember when you could have gotten it a lot cheaper.
You brought up Bitcoin, and that is a great segue into my experience with cryptocurrency. We had our trading summit in Las Vegas, and I want to say it was 2015 or 2016. I can't remember if you were at that one, Patrick. But I remember a couple of our traders were really into this Bitcoin, this cryptocurrency. And they told me about it. They're like, Rob, you got to buy some. Now, Bitcoin was at about $80, $80. It had been up to like 300, and then it crashed back down. And they were telling me, Rob, you got to buy some of this. I'm like, okay, tell me what it is. They're like, you take your real money and you turn it into fake money. Now, look, that's not what they said. But that is just literally what I heard. That's all I heard was you take your real money that you worked hard for, and then you turn it into fake money in the hopes that everyone else thinks this fake money is real money eventually. And I remember telling them, that's the dumbest thing. That's the dumbest thing in the world that I've ever heard. And I passed on it. I said, you guys are crazy. I watched it and I watched it. And pretty soon I had to recognize, hey, this is a thing. But it wasn't at $80 anymore. It was like at 300. And I'm like, I can't buy it here at 300. I'm going to watch it go back down. And we all know the story. So I am very, very proud that my first Bitcoin purchase was in the 600s. That was my very first one. Now, yes, 1,000% late, but I was able to get over this $80 that I saw and actually buy into it. Now, look, I did not buy into it much, but the fact that I bought into it, it makes it easier for my second purchases and my third purchases. You've got to get over that hump on that first purchase. And so I missed a lot of percent, but I'm very happy that I was able to finally get over that. And then in 2019, I still didn't believe it in 2018, but I thought, all right, let's put some money into this just in case. And in 2019, when I saw all my nieces and nephews were putting all their money into it, I realized, hey, this young generation believes it's real money. And pretty soon, they're going to be the ones running everything. And if they believe it's real money, it's real money. And so Bitcoin, we all know the story, has absolutely taken off. Patrick, I remember you telling a story about Bitcoin. Can you remind us of that one?
Well, it's pretty recent, yeah. So when I bought in, there wasn't a ton of regret because I was getting it kind of sold to me during the run back in 2017. Now, it still took me a while to get on board with it too. I like the idea, but I'd seen different forms of internet money in the past, and they all failed. So I was like, well, what makes this so different? But I finally got orange pilled in 2020 and bought my first at 8,600. And a lot of people got in earlier than that, like you did, and a lot of people who listen to my investing podcast got in earlier than that, or a bit later, or in the $20,000, $30,000 range. We're currently today sitting at 67, I think, and a lot of people don't want to buy because they remember a time when it was a lot cheaper, and it's our little inner child just having a hissy fit saying, I don't want to buy at these prices. I want to buy at 12,000. Well, that day's probably not going to come anymore, one. Two, if you did buy early and you buy now, all of a sudden, I think our brains tell us that we were really smart to buy back then. If we add on now, then that means we're less smart. Like over the years, we've actually gotten dumber. And nobody wants to come to grips with that. But it's not true. I'm very bullish on Bitcoin still long term. So therefore, I still think it's quite cheap right now. Only reason I'm not rushing to buy more right now is because I already have a decent amount and I want to diversify out further. That's really it. So I think if people just understand that cheap is cheap, no matter what the price is, if it's something you really believe in, but we don't do that because I don't know if it's our ego or if it's what you're talking about, Rob, that's really standing in our way.
I think some of the terminology you just used absolutely highlights why our brains F this up. When we look at things as far as cheap and expensive, that's great if you're looking at eggs. That's great if you're looking at cars. When you are looking at investments, which trading is you're looking at an asset that you're going to buy or to short because you think the price is going to go higher. We can't use the words cheap or expensive until we know where the exit price is. So let me just ask you this question, Patrick. There's a stock at $20, and in 1 year you're going to sell it. Was it cheap or expensive at $20?
Did I sell it for a gain or a loss?
Well, you don't know yet.
Well, then I can't really say. I feel like I do enough due diligence to where if I'm buying something, I don't buy things when they're overbought and pricey. I like to buy everything when it's cheap, so I will say cheap.
All right. Again, these are the terminologies that really get us because whether it was cheap or expensive is going to be determined by where it is when you sell it. So if you sold it at $40, was $20 cheap or expensive for that investment?
It was absolutely cheap.
Yeah. But what if you sold it for $10? Was it cheap or expensive?
Well, here's where my bias kicks in. And I think we all do this. And I hope this doesn't throw you off your point, but I will say that it could still be cheap. Just, unforeseen things may have happened in that time frame. And some of this could be my ego telling me that I don't want to admit I was wrong when I bought something I thought I was cheap. So I could very well be wrong. Don't throw that option out the window. That's still on the table. But as bullish as we can be on the things we like sometimes, I don't think I would answer that question in the obvious sense. I would say, hang on a minute. I could have still gotten it when it's cheap, even though it's cheaper right now.
Well, that right there is loss aversion in a real life situation. Right there. The definition is it is absolutely expensive at 20. Now look, if you don't sell it at 10, like you planned to do, remember you were going to plan to sell them after a year? You would be very happy to sell that one at 40. You would be very happy to take your double, pat yourself on the back. But that one you bought at 20 that was sitting at 10 and you said, I'm going to sell this after a year and it's at 10 and you start making justifications, this is the loss aversion. This is the status quo effect. This is exactly what we're talking about, is that you are going to be very unlikely to take that loss. Where you were very, very happy to take your gain, you're going to be very unhappy to take this loss because it hurts twice as much. So it's going to cause you twice as much issues when it comes to following your trading plan. You said, I'm going to sell it after a year. It went down to 10. You're going to find all these justifications to hold on to it. Now look, maybe that was cheap. Maybe it rebounded and maybe it ended up going to 100 and you were great. And then that it means that $20 was cheap versus where you closed it. But on any investment or trade, whether something was cheap or expensive is only determined from when you close the position. Now, do you see how that, and again, I'm not just talking to you, Patrick, but everyone here, reframing the terms cheap and expensive will completely liberate you from some of these loss aversion biases.
Yeah, and I feel like I do a pretty good job of this. And I didn't always. But now, if I buy an asset, Forex pairs are different because you can go past zero. That's a totally different asset class, right? But if I buy an actual asset of something I believe in, then I'm typically likely to take a lot of drawdown and probably never sell it because of the chance that it could go back up, because that's often what assets do, especially if they have value. And if it didn't have value, I wouldn't buy it in the first place. On top of that, I like to put myself in the asymmetrical investing pool. And I know through experience, because I'm no stranger to this pool, that things go up and down a lot. But when they go up, they can shoot up like crazy. You just never know when that's going to be. And you're going to have to eat a lot of shit along the way. So I'm just kind of built for this, and I'm ready for it. So if things drop, really the only time I would ever sell is if there was something terminal, or if I just needed something to sell for tax loss harvesting. That's really the only reasons I do it. I'm pretty much conditioned to let things go if it's something that I put my money and my thoughts into.
This goes back to our investing podcast, which I really loved. I loved that investing podcast that we did together, where I really came out, and you could tell how fired up I was. What's a trade and what's an investment? And I said, basically, an investment, you don't ever sell it. You just dollar cost average it and hold it forever. And you buy asset classes. I 100% agree with you. 100% agree that that's how you handle investments. When it comes to trading, you've got to treat it differently. And that was the point I tried to make so strongly, is that trading is completely different than investing. They're two totally different worlds. In the world of trading, if you sold it for less than you bought it for, it was too expensive. Period. End of sentence. No justification. No, but it has a PE ratio. Who cares? That's the world of trading. And so that's what I'm trying to do. I'm trying to get people in the world of trading to completely change the topics of cheap or expensive. And that's why I really like you use terms like overbought and oversold. Overbought and oversold are not necessarily cheap or expensive. They are overbought and oversold. That is a totally different definition than cheap and expensive. I do not like any of my traders to use the terms cheap or expensive when they are telling me about their trades. The other thing I do all the time is when a trader tells me, hey, Rob, I would like to know what your opinion is on this position. And I say, great. I'll give you my opinion. And they're like, well, I got in, and I always cut them off. Say, look, I don't care where you got in. Do not tell me where you got in. That's meaningless. And frankly, I don't want to know where you got in, because I don't want to have that information in my brain for when I look at this chart and tell you my opinion of what's going on. Because we anchor into these cheap and expensive things. And if I know that a trader's in this at 24 and it's at 26, I might think, you know what? Maybe they should sell it because I don't think it's going to go any higher. Maybe I'm lying to myself because that cost basis is coming into me. So this is really, this loss aversion, it pops up so many times in trading, and you really have to be aware of it.
There's two things I want to say to this. One, I'm glad you brought that up, because the difference between trading and investing, because when I started talking more about investing, when the trading material ended, I would say things and commenters would come and say, now, wait a minute, VP, you told us back in a trading video that it's like this. And what you're saying contradicts that. I'm like, it does. But trading is not investing. And that goes back to what you're saying about cheap and expensive. Those are investing terms. Those are not trading terms. In the actual trading world, nothing is cheap and nothing is expensive. So stop looking at it that way if you currently do. Those two words, in my opinion, and you can agree or disagree with me here, Rob, have no bearing, have no use in the world of trading. And if you use them, then you're really taking everything in the wrong direction, in my opinion.
Amen. I could not agree more with what you said. They have no right to be in trading discussions. You can use terms like overbought, oversold. You can use terms like support and resistance. But you should never use the terms cheap and expensive. It's only going to cause you this loss aversion bias.
I'm sorry, Rob, if you're a no-nonsense Forex trader, we don't even like those words, but I know what you're saying. Carry on, please.
Yeah, just when you say something's cheap, understand every word you say has an effect. And I told my kids as they were growing up, like, look, whatever you do, be deliberate. Be very deliberate on what you say, on the things you think. And when you think, oh, this is cheap, when you say that word cheap, it causes your brain to think in a different manner than you want in the world of trading. You know, when something's cheap, it can't get all that much cheaper because it's already cheap. It causes all these issues that you really just want to get rid of. And probably the biggest issue I see with loss aversion is it leads to a negativity bias. It leads to a negativity bias in two ways. Number one, since taking losses is more hurtful than taking gains, most people are very scared of market crashes. Now look, as a trader, you should have no bias to long or short. You should have no bias. And hopefully you're working on that. You should go long when the market's going up. You should go short when the market's going down. Who cares? It doesn't matter. But look, let's be honest. Most people have a long bias, especially in the stock market. I don't see it in the Forex market as much, but in the stock market, there's a very strong long bias. So if let's say 80 to 90% of your trades are long in nature, potential market crashes are very scary. Very, very, very scary to you. And they're going to cause you, when something gets, quote, expensive, it's going to cause you to react.
Yeah, I'm jumping in a lot more than I thought here, Rob. Sorry about this, but I just keep coming up with really good examples that are relative to me, and so I feel like they could relate to a lot of you out there too, possibly. But you talk about being deliberate, and that's what you have to be during trading or when you're trading. But a lot of us aren't that way. Now, a lot of people have come to know me as a very blunt, direct, deliberate person, and I am. But that's not always how my brain works. You know, I'm thoughtful on certain things. You know, if I see something on the news that's politically charged, I don't just react to it and get all emotional. I try to think of, you know, why is this being presented to me? What also could have happened? What are the second and third order effects of this? You know, maybe somebody did this to get to a certain, you know, I always try to think about stuff like that. And this is exactly why I was really good at mathematics, but I was terrible at algebra. Because math just is what it is. Just like trading is what it is. 2 plus 2 is always 4. I don't care what the new math tells you. 2 plus 2 is 4. And I can get my head around that. With algebraic formulas, I would always think like, okay, well, they're telling me to do this, but there's always these exceptions here, and maybe this could be this, and blah, 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 blah. And I took algebra 3 times and failed every time. And they just kind of gave up after a while. And that's, if you bring that attitude to trading, that, you know, I'm going to enter this, but, you know, there could be this, or, you know, it's still cheap and this kind of stuff. You're taking your brain in 1,000 different directions, and none of them are going to get you anywhere, ever. You have to completely enter that headspace to where things just are what they are. There is no cheap. There is no expensive. It's just the market. Like you always say, Rob, the market is the market. Trade the market in front of you. That's all that it has to be. So if you struggle with what I just explained in real life and you try bringing that into the trading arena, the game is over before it even starts. People who think that way cannot possibly follow a binary system like you need to follow here.
Absolutely true. I mean, it's not even possible when they go into the world of trading because they haven't done the work that we've talked about in this psychology podcast to even fix the biases that are inherent to us as human beings. I want to get back to this negativity bias because this is the one that I actually really wanted to focus on this one the most, is that if you are a long-only trader or heavily long, then potential crashes will scare you all the time. And I can't tell you how many times I see traders, and I really try to beat on my traders. We do lots of videos, we do lots of sessions together with our traders. And whenever I see a market like we're having right now, where it just goes up every single day, people all of a sudden, they start to step away from the market and they're like, hey, the risk of a pullback is too great here. It's gone up too much. It's done all this stuff. And I look at it as, oh my gosh, it is so good right now. You should be tripling up. You should be quadrupling up because right now we're reaching all-time highs. This is the best it's ever been. Why would you not want to be fully invested when it's the best it's ever been? Patrick, do you see the difference in the attitude there of fear and maybe greed on my part, but not just greed, but seeing an opportunity for what it is? Why do people feel fear when markets hit all-time highs? Now, I can answer that because I used to be a perma bear. Every all-time high that was hit, it was a joke. It was terrible. It was just setting up all the idiots for the fall. Patrick, you've ever known anyone that's thought like that?
Oh, yeah. And I have a couple thoughts on this, especially as it relates to trading. This is, again, why I don't really like overbought or oversold, because I don't think the Forex market is ever overbought or oversold. I mean, it is it can get to a certain point to where it's so bad, to where the government will step in and say, okay, we need to do something about it. But until that point, currency pairs can just keep going and going in one direction. So when people have it in their mind that it's like a rubber band and it's stretched out, and this whole reversion to the mean and stuff like that, I'm just not, I don't buy into any of that. That can be a real problem. So that alone, maybe it's a real thing, maybe it's not, but I don't think it is, and I don't want people thinking that, because that prevented me in the early days from being a trend trader. Because I'm like, okay, I'm just going to wait till things are overbought and oversold and then catch that reverse. That's exciting. But that's a really terrible way to trade, in my opinion, for all those reasons. Bringing it back to what you said earlier, it made me think of, why people like to just go long or even just go short. Because this is a real thing. I've gotten correspondence from this, from traders a lot. A lot of people will only want to go long, for example, because that's what they've seen, like with the stock market. Going up is what you want to do. Or going long also denotes positivity. Things are well. When things are doing well, things go up, and you want to be a part of that. To where going down, I guess people are less likely to want to take that step for some reason. They just can't get it past their brain. But conversely, I've had a lot of people email me and mention in the comments section of some of my videos, they say, why is it that I only want to go short? And going short is the only thing that really feels right to me. And I'm like, let me guess. Is it because of gravity? And they're like, oh, that's it. I never thought of it that way. I'm like, you know how I know? Because I used to think that too. Or I used to feel that too. I knew it was wrong. But I still liked going short a lot more than going long because gravity naturally pulls things downward. So yeah, I'm not sure how relevant these are. I think there are some relevancies here, and you can pick those out. But yeah, there are, I'm not going to call them valid reasons, but there are plenty of reasons of why people might feel all of those things. And I have either seen them all or experienced them all myself too. So yeah, they're real.
Well, Patrick, after the dot-com crash in 2001, I bet if you looked at my trades in 2002 and 2003, they were 85% short. I had a very, very heavy short bias. And as you said, I always justified it as everything has to go right for a stock to go up. But if one little thing goes wrong, the stock goes down. So any little thing that would happen, it would send it down. And it was a real problem for me because I didn't even understand yet of this loss aversion we're talking about, is that when the markets did drop, I felt twice as bad when I was long than I made when I was short. So of course, if I go short, and the market drops, I feel good and it goes again. Or if I'm long and it drops, I'm going to be on the side where I feel good about it and I don't feel twice as bad. So it's all tied up in all of these biases we have. And I really want to get into the session where we talk about how to overcome this loss aversion bias. I really like what we did and said in the investing podcast, where we basically said your biggest risk is to not be in. Now look, we can't take that automatically into traders because that leads to overtrading and a bunch of other problems. But your fear should still be the fear of missing out. And look, we did a whole episode on FOMO. Go back to that one. There's the wrong way to do FOMO. But when the market hits an all-time high, you should be thinking, oh my gosh, what if this keeps going another 4, 5, 6%? How can I make trades that will be safe in that environment? Not, oh my gosh, it's gone up too much. It's not going to go up anymore. I'm not going to be a sucker holding the bag. You are going to miss way more opportunities than the few times you bought at a high and it reversed and took you out of a trade. And guess what? If you're trading correctly, it's just you had your stop in, you had your order in, and it took you out just like any other trade you made over the last 3 years took you out. But you see how that fear of that loss will keep you out of trades. We need to reframe this to, hey, you know what? Losses suck. I know I'm going to take them, but I need to make as much money on my winners as I possibly can. That's where your focus is. Not in, oh my gosh, this one's gone against me. I don't want to take the loss. Screw that one. Take that loss. Who cares? Get into something that's great. That's how your attitude needs to be. And it took me years to overcome being a perma bull, and it took me lots of introspection and thought about it. So if you find yourself as a perma bear, if you're a perma bear and you're scared that the market's going to pull back all the time, so you're too scared to get into it, you've got to work on that. That's simply loss aversion. You simply need to reframe it to where your greatest risk is missing out.
And I just want to highlight and remind everybody, too, that when Robb talks, Robb is speaking from his arena. And at Maverick Trading, you can not only trade Forex, you can also trade stocks, you can also trade currencies. So my hardcore strict Forex traders understand that there are differences here. Now, as we kind of transition into the solutions part of this episode, I will just say, and I'm sure, Robb, you're probably going to continue on this too, that a technical analysis system is a good way to take a lot of this away. It's still going to be there, and that's why we make episodes like this. But if you're wondering if something is overbought, oversold, you have a nice bias to the upside, whatever, your system is going to tell you when to enter regardless of any of these things. Sometimes it's not even going to make sense, but it doesn't matter because, like Robb said, the right type of FOMO, fear of missing out, is to make sure you don't miss out on the trades that are given to you by your system. Full stop.
Patrick, the thing I love the most about your channel, and it's something that people don't even recognize, because I go in and I read the comments. I love all the comments on your videos that talked about how they struggled before they found your channel, and now they're doing great. Now they're thriving. Now they're passing challenges. Now they're joining prop firms. Now they're trading their own capital and doing great. And the funny thing is, I think most of them feel like it's because they follow the technicals. Yes, all that stuff matters, but what it's really about and what you have been able to really get into people's heads is that you need to build a system, you need to backtest a system, and you need to trade that system, and I love your saying, and get the hell out of the way. When you stress that to people, they are taking that advice and basically overcoming all of these podcast episodes we're doing. We're doing all the podcast episodes on how you can screw this up. If they do what you told them to do, and the people that do it, they end up leapfrogging, having to learn all of these biases that we all have and how to fight our biases. Yeah, they're still there a little bit, but you have done 95% of the work. It's absolutely imperative to trade in a systematic manner and get the hell out of the way.
Well, I appreciate that, Robb. And I like to think that it's more the money management and psychology side of things, which a really good trading algorithm should kind of encapsulate in itself. And I'll even get people that say something kind of passive aggressively to where they're like, yeah, I don't really like VP's technical analysis at all. I think he's a doofus. I hate indicators. But I got to say, the money management and psychology stuff are, if you listen to anything, listen to that. So I'm like, oh, well, thank you for the half positive comment. But yeah, that's really what it is. That's what makes podcasts like this so important, because nobody really covers it. And if they do a terrible job of going in depth. And as we've seen, and as people who listen to this podcast understand, you need to go in depth on these things, because no matter how much we want to follow our system the way I tell you to, it's much harder than it looks. So, Rob, not only just following a trading system, you have some other possible ways to fix this loss aversion problem that people have. And I'm curious to hear you. I can see them on the outline. I'm curious to hear you expound on them a bit.
Well, two are actually right along the lines of systematic trading. I had systematic trading, and then I have trailing stops. So trailing stops, if you don't know what they are, please jump online and learn from someone else. A trailing stop is just a stop where you have a maximum loss you're willing to take, but you don't have a maximum gain that you're willing to take. You are letting this trailing stop dictate where you're going to get out of the position. We use this in the Flat Earth Trading Society on 100 random trades, and it ended up producing a 15% profit over 100 trades. So it can work. So again, but it's all about systematic trading. The reason it worked is because we did it the exact same way 100 times in a row. And Patrick, I want to go back to what I said earlier. The greatest thing about your channel is that you and I both know trading is really hard. It's really hard, not because of it's hard to learn technical analysis. That's easy. It's really hard because the market is really good at getting you to break your rules and really good at deviating from your system. And in our podcast, basically all of our episodes have been about things that make you deviate from your system. And you have been able to get people to buy into their system, test it to where they're really confident in it, and let them run it. So that is how you overcome loss aversion, is you believe it, you believe in it, you go in, you trade it. If there's any issues, you fix them, but let it run. And then like the Flat Earth Trading Society, you just let it run and you see, holy crap, this actually works. And it reinforces even more to not deviate from your system. So that's really the way to overcome this loss aversion, is to create a system, backtest it, trust in it, trade it, make adjustments if you need to, and then just keep going. That's really the whole key to it.
And it's the whole reason why I created the system I created. Because, look, price action's fine. There's a lot of people who did really well with price action and still do. But for me, the way I just told you my brain worked, when there's all these other exceptions that could come up, I needed something a lot more definitive. I would be looking at price action, I would say, okay, well, we're breaking this support line to the upside. But this other thing is telling me to go short on this other time frame. Which one am I supposed to follow? Even if you tell me it's this one, I still have this other thing over here telling me to go the other way. And so I don't have confidence in what I'm trading in. And that's going to be a problem, especially if I take a loss, because now I'm going to second guess why I did it in the first place. So, love indicators or hate them, at least they give you something definitive. And that can really go a long way, because it takes a lot of these other things, including what we're talking about today, out of the equation altogether.
And that's the key, is that we have all these biases as human beings. Yes, we can work on them. Yes, we can try to get better at them. But why not just create a system that jumps them all, that fixes them all? And that's just what I love about your channel, and I really hope that people have been taking from you, is that if you follow systematic trading, you are going to fix a lot of your issues. And if you ever break your rules of systematic trading, it's all psychology. It's nothing about your system. It's all about you. You just got to fix that.
Yeah. And so even though the systematic trading system can help eliminate this, it doesn't mean it's not still there. And it doesn't still mess with us. So that's why we do episodes like this, to not only identify the problem, because you can't fix something you can't identify, but to talk about what's really going on inside of our brains and why we probably feel this way. And if we can at least do that, then we can come up with a solution to try and get rid of it as best we can, even though the overall solution has been obvious to us since day one. It doesn't mean these things still don't exist. So I hope Rob and I were able to shed a lot more light on this and help you move on and get rid of a lot of these things that are weighing you down. And Rob, on that note, do you have anything else to add here?
Nope, that's it.
All right, well, we've gone over 50 minutes, so that's a good thing. Thank you, everybody, for joining us here on the Trading Psychology Podcast. Rob and I will both See you in the next episode.
Goodbye, everybody.